The S&L crisis, how deregulation became a $124 billion heist. $123.8 billion. That's what American taxpayers paid to clean up a financial catastrophe that nobody went to prison for. Not one executive. Not one regulator. $123.8 billion, equivalent to $330 billion in today's money, transferred directly from your pocket to cover the losses of an industry that bet everything and lost. And the worst part? We watched it happen in real time and did nothing to stop it. Let's set the stage. It's 1979. Paul Volcker takes over the Federal Reserve with one mission: kill inflation by any means necessary. He raises interest rates to 20%. The economy screams. And that's when the trap springs. Savings and loan associations, thrifts, had locked themselves into a financial prison. For decades, they'd operated under a simple business model: take deposits from regular Americans and lend that money out as 30-year mortgages at fixed rates. When Volcker's rate spiked, thrifts found themselves paying 12% interest on new deposits while earning only 6 or 7% on old mortgages. They were hemorrhaging money on every single account. By 1983, roughly one-third of all S&Ls in America were technically insolvent. That means they owed more money than they owned. The system was broken. So Congress did what Congress does when an industry has a problem: it rewrote the rules. In 1982, the GONST German Depository Institutions Act passed with bipartisan support. Read that name carefully, both parties owned this. The law was supposed to save thrifts by letting them diversify. Instead, it handed them a loaded gun. The law allowed thrifts to move beyond mortgages into commercial real estate, junk bonds, and risky development projects. It lowered their capital requirements, meaning they could lend out more money with less actual cash on hand. And it allowed accounting tricks that let insolvent institutions stay open and keep taking deposits. This wasn't a mistake. It was deliberate forbearance, a regulatory term for "we know you're broken, but we're going to pretend you're not." By 1985, new thrifts were opening at a pace of 250 per year, mostly in Texas, Arizona, and California. These weren't cautious community lenders. They were turbocharged gambling operations led by men with names like Don Dixon, Charlie Keating, and Ernst von Wetzel, operators who saw a deregulated thrift the way a teenager sees a stolen credit card. Take Charles Keating. His Lincoln Savings and Loan became a symbol of the era's excess. By 1989, Lincoln had $5.3 billion in assets and was nearly insolvent. Keating had used thrift deposits to buy junk bonds, fund real estate schemes in Arizona, and bankroll his own network of companies. When regulators tried to intervene in 1986, Keating had his 5 U.S. senators, including John McCain, call the Federal Home Loan Bank Board. The regulator backed off. That meeting is now remembered as the Keating 5 scandal. Lincoln's failure alone cost taxpayers $2.6 billion. One institution. One man's gambles. $2.6 billion. But Lincoln was one of 1,043 thrifts that would eventually fail. Here's what the official narrative missed: the Federal Reserve warned everyone in advance, and everyone ignored it. In 1984, for years before the major wave of failures, Fed economists published research showing that commercial real estate lending was unsustainable and that the thrift industry was heading toward collapse. The paper was buried. Nobody in Congress read it. The industry dismissed it. And regulators lacked the teeth to enforce their own warnings. But the real story goes deeper. The FSLIC, the Federal Savings and Loan Insurance Corporation, was the agency supposed to protect depositors. By 1987, the FSLIC itself was insolvent. It had $15.3 billion in liabilities but less than $1 billion in reserves. It couldn't pay its obligations. This is the hidden mechanism that made the crisis inevitable. Regulators had to let broken thrifts stay open because closing them would bankrupt the insurance fund immediately. So they chose slow death over fast death. They allowed insolvent institutions to keep operating, which meant insolvent institutions kept making worse and worse loans, which meant losses kept compounding. Every closed thrift made the FSLIC's problem worse. Every open thrift made it bigger. By February 1989, Congress was forced to establish the Resolution Trust Corporation, a $500 billion government agency, just to manage the cleanup. The RTC's job: sell off the assets of 1,043 failed thrifts in a collapsing real estate market. Imagine selling 1,043 houses simultaneously during a recession. You don't get fair value. You get FI sale prices. And guess who pays the difference? The taxpayer. By 1999, the total cost was $123.8 billion. Industry losses added another $29.1 billion. The total wound, $152.9 billion for a single sector's deregulation experiment. The savings and loan crisis teaches us something about how regulatory capture works. It's not a conspiracy, it's a system. When you tell an industry you're in trouble, here's deregulation, you're not saving it. You're giving it a last chance to gamble its way back to solvency. Some will succeed. Most will blow up spectacularly and take public money with them. The thrift executives who caused this didn't face criminal charges because they weren't technically breaking laws, they were operating within a new legal framework designed to let them fail safely. The system had been rewritten in their favor. Charlie Keating argued that his actions were within regulatory bounds. By the legal definition of the moment, he was right. 20 years later, we deregulated banking again. We allowed leverage. We allowed complexity. We eliminated Glass-Steagall. And we told ourselves the lessons of the S&L crisis had been learned. Then 2008 happened. The game changes, the players change, the scale changes. The structure remains. This video is for educational purposes only. Not financial advice.